Hello, everyone, and welcome to another Wall Street for Main Street podcast. Today is a first-time guest. He's a first-time guest, but I've been following his work for a long time, roughly since 2009. He is one of the biggest names in Austrian economics. This is Peter Schiff, President, CEO of Europacific Capital, Europacific Bank, and his precious metal bullion company, Schiffgold. Peter, thank you for coming on our show.
Hey, thanks for having me on as a guest.
Thank you. So first thing I want to get into is this Friday's job numbers. The press basically said it was a great number. They're hailing it as proof that the recovery is still going strong. But when you look beneath the headlines and the actual data, it pretty much seems like it tells a different story. What are your thoughts on the job numbers?
Yeah, well, I think the jobs numbers are the outliers, number one, because if you look at the other economic data that's been coming out, certainly, for 2015, but even most of the data from the fourth quarter of 2014, it has consistently been below estimates. In fact, a lot of the data has been very bad. In fact, you'll keep seeing data that comes out where they'll say, well, this is the last time we had data this bad was 2008 or 2009. And there's a lot of economic data where you have to go back to the Great Recession to get numbers as bad as the numbers we're seeing now. And I keep hearing people say, well, but the economy must be good because the jobs numbers are good. And so people are making excuses for all this bad economic news and assuming that, well, it's going to turn around, to meet the good jobs numbers. Instead, it's more obvious that maybe the jobs number is the outlier, the aberration, and that the jobs numbers are going to turn south to be better aligned with all the other bad economic data that keeps coming out. That's number one. But number two, I don't think the jobs data is as good as everybody believes because I think they're just taking a very superficial look at the number. I mean, first, when it comes to unemployment, yes, the unemployment rate has come down dramatically from where it was at the peak. But you have to look at why. You have to look at the dynamics. What is driving the reduction in the unemployment rate? Because it's not a bunch of unemployed people getting jobs. That's not what's happening. The big momentum is people leaving the labor force. So people who used to be considered unemployed because they weren't working, they're still not working, but they're no longer considered unemployed because, in theory, they're not looking for jobs. They've thrown in the towel, and they just left the workforce. So that's part of it. The other part of it is the type of jobs that people have. When they passed Obamacare, they basically told a lot of employers that you need to fire your full-time workers and replace them with part-time workers, or you need to take the hours that your full-time employees are working and reduce them, and then go hire some extra part-time people to make up the gap. And so that's what's going on. And so the reason we keep creating 200,000 plus jobs a month is because a significant number of those jobs are part-time jobs. And so if it wasn't for this dynamic, we wouldn't be creating all these jobs. But we're not creating full jobs. We're creating part-time jobs, and so many people now have two jobs where they used to have one. But they're not making more money. They just have two jobs. But as long as you work 1 hour a week someplace, that's a job. And so the types of jobs that are being created are low-paying part-time jobs. I mean, we have record numbers of people now that work in bars and restaurants. A lot of these people have college degrees. The fact that our college grads are having to settle for jobs as waiters is not indicative of a strong economy, especially when so many of these college grads borrowed all this money to get their degrees, and now they're just serving hamburgers. So the numbers just on the surface don't tell the real story. You got to dig a little deeper to see what's really going on.
Yeah, I definitely agree with that. And speaking of what you brought up with the college degrees, they actually had a thing where they're trying to pass a law to declare bankruptcy. And to me, that just looks like a disaster. You got people working with six-figure plus debt. Meanwhile, they're working a minimum wage job.
Yeah, I don't know. They're trying to do something to make it easier to discharge your student loans in bankruptcy. And I don't know what they're thinking about doing, but whatever they do, there is a huge moral hazard there. And what is going to happen is if you make it easier to go bankrupt, right, and get rid of your student loans, then two things are going to happen. One, colleges will be able to raise their tuition even faster because now they know that the students have a way of getting out from under the debt. And generally, probably the more you owe in your student loans, the easier it will be to declare bankruptcy. So if you need a lot of student debt to go bankrupt, then having a lot of debt is better than having a little bit of debt. And if the students know that they can discharge their debt in bankruptcy, they're much less concerned about running up the big debt in the first place. So colleges will be even more incentivized to jack up tuitions, and students will be more incentivized not to care, right, or to pay the higher amounts. And number two, students will try to put themselves in whatever circumstances they need to be in to qualify for the discharge. Because if you think about the typical college student, the day he graduates, he is flat broke, right? He has no assets other than a worthless degree and a lot of liabilities. He has his student loans, maybe he has a credit card loan, maybe he borrowed money and bought a car, so he's got credit card debt, an auto loan, and student loans. He's got a negative net worth. He is in a perfect position to declare bankruptcy the day he graduates. But, and I don't know if the Obama administration will say, look, you can't declare bankruptcy the day you graduate. Do you have to wait 2 years, 5 years? But whatever the waiting period is, the individual will have an incentive to be in the worst financial shape he can possibly be in at that time period. Because there's a huge carrot there. I mean, if you have $50,000 or $100,000 in debt, it makes sense to be as broke as possible to get rid of that debt. Because even if they tried to be responsible, why would you want to save $20,000 or $30,000 if it meant that you couldn't get rid of your $100,000 in student loans? I would want to have another $20,000 or $30,000 in debt because I maxed out my credit cards and spent every penny I had, so that when I got to that time period, I could qualify for bankruptcy and get out from under the student loans.
Yeah. Oh, yeah, that definitely makes complete sense. And with the economy and the jobs, you see some numbers contracting, like the PMI of Chicago. It's inevitable, in my opinion, but I want to go to another topic. Most recently, you wrote about this in your newsletter about, and you've been talking about this, is the Fed and being patient on interest rates. Do you see the Fed trapped now? Because in my opinion, I see bubbles in a lot of assets, and I just don't see how the Fed can raise rates.
Well, they can't raise rates without precipitating another financial crisis, right? I mean, what people don't understand is that we never had a legitimate recovery. All we did is inflate a bigger bubble. And because we inflated another bubble, none of the underlying problems were ever solved. In fact, in the process of inflating the bubble means that we exacerbate all the problems. So when the Fed stops stimulating, we're just going to find that we're in a bigger hole. It's like, if the dentist, shoots your mouth up with Novocaine and then he does a lot of work in there, you don't really feel like the pain until the Novocaine wears off. And we're not feeling the pain that has been created over the last 5 or 6 years, but because we're still high on the Fed's Novocaine. But now that they've even stopped QE, I think the bubble is deflating. If they were to raise interest rates, it would deflate even faster. So I think what the Fed has been doing is just bluffing. I think they've been pretending that they could raise rates, but I think they know that they can't, because the whole phony recovery is built on the foundation of cheap money. You can't take away the cheap money unless you take away the recovery. And since the problems are so much worse now than they were before, we're going to be in a bigger hole than we were when the Fed started digging, in 2009. All this quantitative easing and 0% interest rates has damaged the economy. So we're in worse shape now than before the Fed started. But I think what the Fed's going to end up doing is QE4. I think it's going to be bigger than QE1, 2, and 3. I think it's just like any drug. You have to keep taking bigger doses in order to, achieve some type of high. You build up a tolerance. And that's what the Fed is going to do. But unfortunately, eventually we're going to overdose on the stimulus. I think the dollar is going to collapse. I mean, it's rallied because people don't understand this. They think the Fed's going to raise rates. They don't realize that's impossible. And even if they do raise rates slightly, it's going to be enough to push the economy into recession. And then what is the Fed going to do if the economy's in recession? They're going to lower rates back to zero and launch QE4. I mean, what else would they do?
Oh yeah, and what people fail to one thing I read about, someone said the S&P 500 PE ratio shows it's not really overvalued, but what they failed to take into account is they're borrowing money since 2009, $2 trillion worth, and they're buying back stocks. So those PE ratios are just very artificial.
Oh yeah, well first of all, they look at it relative to interest rates, but what happens if interest rates rise? You can't justify these PEs, and a lot of the companies, if interest rates go up, their earnings are going to come down because a lot of their income is derived from their cheap borrowing costs. And also, if you look at the share buybacks that have been driving those earnings, the companies last year, U.S. companies spent about 97% of their earnings on share buybacks and dividends. So, they haven't been modernizing their plant and equipment. In fact, the average age of plant and equipment is the oldest it's been in 65 years. So U.S. companies really have to catch up on their capex, which means future earnings are going to have to come down dramatically in order to make up for what they haven't been doing recently. So the earnings going forward, when you look at rising capex, rising interest rates, and of course if the markets go down, then a lot of these companies are going to have to divert more income to their pensions, shoring up their pensions, which will be dramatically underfunded if we get a big drop in the stock market or increase in interest rates. The possibility of earnings collapsing is very real. And then if you take, so there's a lot of risk in the U.S. stock market. But of course, nobody wants to recognize that. But the real risk could be in the dollar, because if the Fed just prints so much money so that the stock bubble doesn't burst, it's the dollar bubble that ends up bursting.
Yeah, and my other question is what you said and talk about makes perfect sense. I'm thinking whenever this crisis comes, how can they not see it coming? But you're on the mainstream press a lot, on Fox Business, CNBC, Bloomberg. It's not like they haven't completely been exposed because they have you on. Why do you think they can't see this coming? What's your opinion?
Well, I don't think that they understand the problem. Remember, very few people saw the 2008 financial crisis coming, even though it should have been obvious. But the reason it wasn't obvious is because people didn't understand the real dynamics of what was going on in the U.S. economy. And the same people that were, in charge back then, that were, running all the big funds, or, people that were at the Federal Reserve, it's all the same people. And so they haven't learned anything. Right? They still don't understand what the problems were. That's why they're under the false belief that the Fed's monetary policy over the past 5 years has, solved the problems, when in fact the problems have been exacerbated by this policy because they never understood what they were in the first place. So they think the Fed succeeded, but they don't realize that it's been a spectacular failure. And so they are going to be just as blindsided by the next crisis as they were by the last.
Yeah. And to switch topics, I wanted to get to right now, it's not, the Fed's done a lot of QE, but recently a lot of people, the ECB and Draghi, they've done QE.
Well, the ECB is just starting. I mean, they just started like a week ago. We've already completed 3 rounds of QE, and they've barely begun. But, I have a feeling that their QE experiment is going to be short-lived, because I think they're having a hard time buying these bonds because the market has already marked them up to the point that they have to buy them at negative yields. And I also think the big rally that we've had in the dollar and the big drop in the euro is going to spark European inflation to the point where the CPI over there is going to be rising at a level that will be intolerable, for the ECB, because they have to keep inflation below 2%. And if it gets back above 2%, or even hits 2%, they got to stop the QE, because they have to keep it below 2%. They're not allowed. They don't have any cushion. They need to be below 2, and they could be at 2 pretty quickly, a lot more quickly than people think, and then that would put an abrupt end to their QE program.
Yeah. Well, one thing is one of the reasons I think they did QE. Would you agree with this? Is I think it's sort of they're trying to keep Greece and a lot of the PIG countries in the Eurozone, and they're hoping to reduce its debt, or not reduce its debt, but make the debt cheaper.
Well, it's not just Greece. I mean, they're trying to bail out the French and the Italians and the Spanish. I mean, all these governments have promised more than they can repay, and so they're looking at inflation as their salvation. But none of this is good for the European economy. It would be better to force these governments to restructure than to help them, take the easy way out. But that is what they're trying to do. They're trying to prevent politicians from having to cut government spending or renege on some of the promises they made to voters. But it's all destructive economically what they're doing.
Yeah. And one thing I wanted to ask you about is 2 years ago when the Swiss pegged itself to the euro, you said the peg wouldn't last. You turned out to be right, that they eventually depegged. Swiss just instituted, from what I read, QE. Do you think, like Europe, that will be short-lived, and why do you think they instituted it?
Well, again, they bought into this idea that a strong currency is bad, that you need inflation and you need a weak currency. And, that's what everybody believes, and of course it's nonsense, but that's what the world believes right now. And so Switzerland was trying to prevent their people from getting wealthier. They tried to, to make sure that they lost as much of their wealth as the rest of Europe. Even though they were smart enough not to want to join the euro in the first place, they were dumb enough to try to tie their fortunes to the euro. They wanted their own currency, yet they decided they wanted to surrender their monetary policy to the ECB, so that their own citizens would suffer as much as anybody else in Europe. So they should have just been taking a bow for having the foresight not to join the euro, but instead they de facto became members, and then they said, okay, enough is enough. But now they've backtracked a little bit. They're trying to keep their currency from going up, which is a mistake. There's nothing wrong with a strong currency. A strong currency is good.
Yeah, it increases living standards. Now, one topic I wanted to get into was, this is a favorite of our audience, is gold. You've been around, I would say you've been in industry since the 90s. Europacific Capital, obviously you're the founder, but before that you even worked Lehman Brothers before you founded Europacific Capital. In your career, have you ever seen a lack of interest in gold like there is right now?
Well, I mean, maybe in the late 1990s was the last time, although, and that was maybe understandable because gold had been the bear market for almost 20 years, and we were in, it was the new economy and the internet boom, and so there was very little interest in gold. But given the fact that gold's gone up, in the last 15 years, the fact that gold's gone up 400% or 500%. The fact that so few people are interested in it really is incredible, and especially when you look at the fundamentals. I mean, interest rates at zero or negative in so many countries around the world, budget deficits running through through the ceiling. There should be a lot of concern for the future of fiat currencies, especially when you have central banks promising inflation. I mean, back in 1999, 2000. Central bankers said that they wanted price stability. They were there to fight inflation. Now the central bankers around the world are saying that they're fighting price stability, that stable prices are bad. We need rising prices. We have to make sure that prices are going up. Most central banks say we want to have at least 2% inflation. And so that means that your money is guaranteed to lose value if you hold it. And normally, the concern about owning gold was, well, when you own gold, you give up interest, because you can deposit your dollars in the bank and get 5-6% interest, and if you have gold, you're missing out on that interest. Well, now you get no interest if you deposit your money in the bank. So why wouldn't you hold gold? There's no opportunity cost, and the risk is if you put your money in the bank, what if the bank fails? What does it bail in? Meanwhile, you're getting no interest on it anyway. I mean, so you're taking all the risk of a bank deposit with none of the upside of the bank deposit. So people should be buying a lot of gold. Instead, there's overwhelming negative sentiment in gold, and so the price is going to skyrocket at some point.
Yeah, I definitely agree, and and I think the catalyst would be. What do you think would be the catalyst to end this bear market?
Well, I think it's going to be the realization of the box the Fed is in, right? That there is no exit strategy. that they're not going to shrink their balance sheet, they're not going to raise rates, they're not going to end QE, that they're just getting started, right? That this really is a monetary roach motel, which is what I said from day one. Once you check in, you never check out. You just keep on. It's like a drug. It's a drug habit. You don't just quit drugs. You're gonna hit rock bottom, right? I mean, there's going to be an overdose. It's going to be a big event, and that'll turn gold when the Fed joins the QE party. When the Fed is back, when the Fed is doing QE4, and people realize that there's no end of this. It's 0% interest rates forever. And it's not just that, we want 2% inflation. Even if we get 4, 5, 6, or 7% inflation, the Fed's going to say, it's not going to do anything about it. The Fed's going to continue to fuel the fire, no matter how hot it burns. Because they can talk about fighting inflation, but they can't actually fight it. Because the cost politically would be too great. If they let inflation get to 3 or 4%, and then they have to jack interest rates up to 5 or 6% to contain it, well, the markets implode. The banks are going to fail. All those too big to fail banks will fail again, except now they're much bigger than they were when we should have let them fail last time. And if we weren't willing to let them fail in 2008 when they were tiny compared to their enormity now, I mean, how are we going to let them fail in the future?
Yeah, and not only that, you were talking about 5 to 6% interest rates. Government revenue is $2 trillion. If interest rates went up to that, their revenue would go solely to paying interest. It wouldn't even be able.
If interest rates go up, right, the cost of servicing the debt skyrockets. But if higher interest rates put us into a recession, then the revenue to the government declines, so the government has less revenue to pay more interest.
All right. And my one other topic I wanted to get into was you've been around Austrian school, I would say basically your whole life. Is that fair to say?
Pretty much. I didn't know that what it was called early on. I didn't know there was a name to what I was learning. But yeah, I mean, my dad pretty much taught me Austrian Economics when I was a little kid.
So my question is why do you think most economists and most mainstream financial people, why do you think they read more Keynes or, Milton Friedman, Chicago School, and not much of, I've known economists who haven't really heard of Rothbard or Mises?
Well, that's because, Keynesianists certainly, and to a lesser extent, monetarists, but these schools of thought appeal to people who like government, because they have a more positive role for government. Certainly, Keynesianism justifies big government in a very convenient way. And so I think people that tend to like government and are skeptical of capitalism are going to favor Keynesianism. And so, that's what you get in our universities. I mean, teachers are overwhelmingly liberal. They're not necessarily free market advocates. And so they're going to welcome the activist role that the Keynesians see for government. And certainly, if you're going to get a job, in the government, if you're going to work at the Council of Economic Advisors to the president, you're going to be a Keynesian. I mean, they want people there that are going to recommend big government policies and government solutions. So, because that's what the voters want. They want to vote for a politician who's promising to do something. And Keynesianism, enables them to do that because it's all about government-provided stimulus. So, the economy is weak, so the government is going to do this program, and it's the Keynesians who will justify it. And, Keynesianism also justifies inflation, which props up asset prices. So economists in the financial sector generally, adhere to those types of policies. They're self-serving, just like, the National Association of Realtors, when they hire an economist, it's always somebody who's positive on the real estate market because they don't really want an economist. They want a cheerleader. They want somebody to help market their products. So Wall Street, when they hire their economists, they want somebody to talk up the market, talk up, the economy. And so the Keynesians are going to fill that bill. There's not most people, I think, like me, right? If you believe in Austrian economics, you're not an economist. I mean, you're actually out there doing something. You're in the business world. You're not an academic. Most of the people who are in academics tend to be socialists, and so they're going to adhere or believe, or more likely to believe in that doctrine of Keynesianism. But the people who really believe in capitalism and the free markets, there's not that many of those that go to teach at our universities, that go work in government. They're generally out there in the private sector. So, they don't have title economists, but they're there. They're just, but if you're a professional economist, chances are you're a Keynesian. Because even like in my view, I mean, if I was an economist and the government hired me and they said, okay, what should we do? Do nothing. Stay out. Repeal these rules and regulations that are screwing up the market. It's like if I was a doctor and I actually went to medical school and I'd learned that there's nothing that we could do, right? That the best thing that you can do when people get sick is just to let them heal naturally. If that's what I obviously I couldn't make a living as a physician if I just told everybody that you're going to heal your body's going to heal itself. There's nothing I can give you. But that's not true when it comes to medicine, but it is when it comes to economics. I mean, if you actually understand economics, the best thing you can do is nothing. Don't interfere. Let the free market work, because that outcome is going to be better than any outcome some economists can contrive, right? But that's not what they want. The government doesn't want their economists to say, do nothing. You can't win an election. Vote for me. I promise to do nothing. No, give me a solution. Give me a government program that's going to work, that's going to make the economy better. Well, that's what the Keynesians will come up with. Of course, it's all nonsense. It doesn't make the economy better. It makes it worse. But it's something they can sell to voters. It's something that they can run on. So this whole sample is so biased because everybody wants that Keynesian economist because it's justifying the things that they want to do.
Yeah, and that's probably why I would say the 1920-21 depression is not widely regarded or widely talked about.
Well, that's because it was over so quickly, because the politicians didn't have a chance to screw it up. I mean, the reason we had the Great Depression in the 1930s is because Hoover reacted in an opposite way, right? I mean, we didn't take a laissez-faire approach. And maybe the main reason that we took the laissez-faire approach in 1920 is because it ended so quickly, we didn't have a chance to screw it up. But Hoover was very quick to implement big government policies early on in 1929, 1930. And the real irony of it is Roosevelt was very critical of Hoover's big government policies, which was correct. He should have been critical. But when he became president, he just adopted them. He expanded them. It was very much like Obama criticizing Bush and then, doing the same thing Bush did, only bigger. Obama criticized all the deficits under Bush. He said, oh, this is terrible, all this debt. But, of course, as soon as he became president, it just was even worse. But, people don't understand the markets, and you have such, the historians are so biased into trying to rewrite history to try to somehow vilify the free market and blame that for the Depression, and not the Federal Reserve, which was instituted in 1913. It was its monetary policy that inflated the bubbles that burst, and then it was the big government policies of Roosevelt. I mean, we were in depression from 1929 through the end of the Second World War. I mean, this is a huge period of time, and how can they say that it was Roosevelt that got us out of it? I mean, Roosevelt was the reason we were in it for so long.
Oh yeah, he served 4 terms. And the boom didn't really come till after the World War II.
Yeah, it's after the war ended, and that's because government shrank dramatically at the end of the World War. But to try to say that he's the reason that it ended, now you have to ask why did it last so long? I mean, that depression was unprecedented in U.S. history, either before or since. Obviously, had we simply taken the same approach in 1929 as we did in 1920. The Great Depression would have been over within a year or two, and it wouldn't have been a Great Depression.
Yeah.
But because we had all the government interference of Hoover and Roosevelt, we stretched it out so long. We just made it so much worse than it should have been.
Oh, I definitely agree. And I was going to say we're almost to the time mark. I know you're a busy man, so I just want to ask the one last question about Austrian economics is that in my opinion, it's grown rapidly since because of the use of the internet. I found it via the internet. A couple of my friends found it via the internet. And I know your claim to fame was Peter Schiff was right. How beneficial, in your opinion, has the internet been to the economic school?
Well, I think it certainly helped at the time, when people could see some of my interviews, that were recorded during the bubble, where other people looked so foolish, now with the benefit of hindsight. Of course, most people thought I was the one that was the fool. But, more recently, it's been more of a Peter Schiff was wrong, right? Because, hey, Peter Schiff was predicting inflation. He was predicting a weak dollar. But look, he's wrong, and see, the Fed's policy has worked. And I think that when this next collapse comes, the Internet's going to play a big part in getting the message out there, because the Fed policy hasn't worked. It's just, inflated a bigger bubble. And so it only works until it implodes. And then you realize how badly it didn't work. Just like the policies I was criticizing, that inflated the housing bubble weren't working. They weren't working from a standpoint of economically, but they were inflating a bubble, and they were sowing the seeds of this crisis. And that's all we're doing now. The policies are sowing the seeds of a greater crisis, and ultimately we're going to have a dollar crisis. We could have runaway inflation. This is going to implode in a big way. And, yeah, I think the Internet will be a big part of trying to, again, get the word out to help explain what's going on. And, yes, this will be seen, I think, as a real failure of Keynesianism, and when Paul Krugman can't keep saying I told you so with his premature victory dance. When the whole thing implodes around Krugman, and he's lost all credibility, people are going to be looking for an alternative. They're going to be looking for an explanation that makes sense, and the Austrians have it. And the Internet is a way to get it out there.
Yeah. Well, I just want to say thank you for your time. I know you're a busy man.
And if people want, I'm doing a lot. I don't do my daily radio show anymore, but if people want to basically, understand my thinking real time, to get my comments on what's going on in the economy and the markets, they can still go to schiffradio.com and listen to my podcasts. I generally record 2 or 3 podcasts a week. They generally range from 15, 20 minutes to 40 minutes. So a lot of information that's there on schiffradio.com, and also any place that they have, podcasts like iTunes or all these various podcast services, you can sign up and just automatically get them. Whenever I record one, you'll just get a new one. And then I do my video blog still on YouTube, on the Schiff Report. So, I'm constantly out there. So people, you don't have to wait, for these interviews. I'm recording stuff all the time that people can listen to.
Yeah, and you also have a newsletter, correct?
Yeah, people can get my free newsletters. We just had a really good issue that came out of our Global Investor newsletter, and you can sign up on any of my sites, but it's Europac.com is the brokerage site, is the website for my brokerage company, Europac.com, and you can sign up to get that newsletter for free. It's emailed to you. And also I have a video letter, too, from Schiffgold.com. So just any of my websites, you can go on there and then just figure out how to sign up for the free letters. I don't charge money for any of the information that I put out. I charge for my investment services. So people that want me to manage their money, then I have a charge. But if you're just looking for information, if you want to understand what's going on, I just try to provide that for free.
All right. And you've also have some books too.
Yeah, I've written a number of books. My most recent one being The Real Crash, which I revised and updated about a year ago. So the newest version is out there, and I definitely would recommend getting that. It's The Real Crash, right. America's Coming Bankruptcy, How to Save Yourself and Your Country.
All right. Thank you very much for coming on.
I appreciate the time. Take care.
All right.